Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about SHENZHOU INTL interim report. SHENZHOU International Group Holdings Limited provides a range of businesses and services, including manufacturing and selling knitwear products, trading activities, production of knitted sportswear, casual wear, lingerie wear, exporting to international markets in mainland China, the European Union, the United States, Japan, and other countries. The stock price of SHENZHOU International Group Holdings Limited has dropped by approximately 9.64% over the past year, due to a combination of factors. One key reason is its underperformance relative to industry and market benchmarks, with the company lagging behind in both US and Hong Kong markets. Additionally, broader market and sector weakness, particularly in Hong Kong's household appliances and electronics sector, has also contributed to the decline. Global macroenvironmental uncertainties and weak market demand have further added to the pressure on the stock price. Although the impact of US tariffs was initially considered limited, it may have still had some effect on the company's earnings. Overall, these factors have resulted in a year of underperformance for SHENZHOU International, leading to its current decline. The primary drivers of revenue growth or decline can be summarized as follows. Revenue growth is primarily driven by increased sales in major markets such as the US, EU, and Japan, expansion of production capacity overseas, particularly in Vietnam and Cambodia, diversification of product portfolio to meet changing customer demands, rising demand for sportswear and casual wear in key markets. On the other hand, revenue decline is primarily driven by weak global demand and excess production capacity in the apparel industry, price-based competition and uncertainties in US import tariff policies, appreciation of the renminbi against the US dollar, affecting exports to the US. Net income and profit margins. A shift in performance. The financial performance of a company has undergone changes in net income and profit margins over time. Initially, the net income increased by approximately 8.4%, rising from RMB 2,931,028 to RMB 3,176,836. However, this growth was not consistent across all metrics. A closer look at the profit margins reveals a decline in both gross and net profit margins. The gross profit margin decreased from 29% to 27.1%, primarily due to rising labor costs. Similarly, the net profit margin dropped from 22.6% to 21.2%. These changes indicate that while the company's net income has grown, its ability to retain profits as a percentage of revenue has diminished. The decrease in profit margins can be attributed to increasing labor costs, which have eroded the company's profitability. Despite the growth in net income, the decline in profit margins suggests that the company may need to reassess its cost structure and operational efficiency to maintain sustainable growth. The company's financial performance indicates a consistent generation of positive operating cash flow. The data shows that in 2024, the company generated RMB 2,692,920,000 from operating activities and RMB 3,244,143 in 2025. This trend is further supported by page 21, which explicitly states that operating cash flow is positive. These figures demonstrate a stable and increasing ability to generate cash from operations, indicating a healthy financial position for the company. The company's debt level has increased significantly over the past period. Net borrowings rose by approximately RMB 0.4 billion to RMB 4.3 billion, while the gearing ratio increased from 35.8% to 39.8%. Total debt also increased from RMB 12.8 million to RMB 14.7 million. Furthermore, current bank loans and total current bank borrowings saw significant increases of 22.3% and 15.1%, respectively. In contrast, interest expenses have decreased. Finance costs dropped by approximately RMB 15.5 million, while interest on bank borrowings and lease liabilities also declined by 8% and 30%, respectively. The interest expense on lease liabilities was reduced from RMB 0.2 million to RMB 0.5 million. The company's financial performance varied across different regions and segments in the recent period. Notably, the European, US, and Japanese markets showed significant growth, with increases of 19.9%, plus 36%, and 18.1% respectively. In contrast, the China domestic market experienced a decline of 2.1%. These results indicate that the company's global expansion efforts have been successful in certain regions, but it faces challenges in its largest emerging market. Management is optimistic about the company's future prospects. Key strategies include expanding fabric production capacity in Vietnam to increase efficiency, investing in technological innovation and green transformation to drive sustainable growth, and fostering long-term partnerships with reputable customers and suppliers to expand its business reach. These initiatives aim to position the company for continued success and growth. The company's financial summary reveals that they have a history of paying out dividends to their shareholders. This indicates a commitment to returning value to investors through regular distributions. That concludes the financial summary for SHENZHOU INTL. Feel free to comment below, and I will be happy to answer them when possible.